Hey, welcome back. It's Nolan Mathias, and today we're going to talk about the whole craziness surrounding GameStop, AMC, and the Wallstreetbets forum. And I'm going to tell it in three parts. First of all, what led us to all of this. Second of all, why you shouldn't necessarily play the wisdom of the crowds when it comes to investing. And three, I'm going to tell you how I did take advantage of the wisdom of the crowds, or at least the lack of wisdom of the crowds, in order to make a pretty significant return on at least a couple of the stocks that were going crazy this week. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where when we hit 10,000 subscribers, we're going to pay one lucky person's rent or mortgage payment for a month just for being a subscriber to this channel. It's super free, and it's super easy, and it's super worth it. So let's get into it. Okay. So let's talk about what happened, and this is going to be very much an informal video, and I got to start with, first of all, I am not an investing expert, so don't take anything that I'm about to say as advice or anything else. This is just purely my understanding of what happened and how I took advantage of what was happening in order to make a little bit of money over the last couple of days. So let's start by talking about GameStop, because this is what started the whole thing. And what happened was, back in 2019, a few investors recognized that GameStop was sitting on a pretty significant amount of cash and not a lot of foresight into where they were going in the future. The company was sitting kind of on the ledge. Nobody really knew what was going to happen with gaming. A lot of people thought that the old, buying and selling discs in a physical game store was going to go the way of Virgin Records or the way of HMV or all the old record stores and CD stores that existed, and they were pretty much going to run out of business. And then there was this other group of investors who said, well, hold on a second. PlayStation, Xbox, they're still releasing consoles that take physical discs. There's probably a market for this, and there's probably a market because people still want to be able to buy and sell the games that they've purchased so that they aren't stuck to one or two games or purchasing a game indefinitely and having to be stuck with it and not having the ability to trade to other products. So there was this controversy around the future of the company. And as a result, some investors started to realize the significant amount of cash that they were sitting on made them a pretty good value investment. And the most notable of these was a guy named Michael Burry. And Michael Burry, Dr. Michael Burry, was the guy who was featured in The Big Short. He was the medical doctor who ran a hedge fund called Scion Capital. And he recognized that the subprime mortgage bubble was about to collapse, and he was the one who bet against the housing market. And he recognized that in 2020, or maybe it was late 2019, I'm just looking at my notes here, that this company, GameStop, was a company that was a very good value investment, and it was just simply being mismanaged. And then a few months passed, nothing really happened. There was a little bit of a bump up because Michael Burry, the famous Michael Burry, was investing in GameStop, but really not a lot happened. And then on a little forum on Reddit called Wallstreetbets, somebody pointed out that 84% of the stocks in GameStop were being held short. And what that means is that investors, major institutional investors, were betting against GameStop, and that 84% of the stocks had been borrowed. So what I mean by that is, and you have to understand how short selling works, is when somebody shorts a stock, basically what they're doing is they're taking a stock and borrowing it from somebody else, and they are selling it on the open market. And then when they sell it, what they are doing is hoping that the value goes down so that they can buy it back for cheaper. And the difference between what they sold it for and what they bought it back for is their profits. Now, what happened in this scenario is pretty much the majority of investors were people who were short selling the GME stock. Now, here's the thing about shorting stocks is, unlike purchasing a stock and hoping that it goes up in value, where you have a limited amount of downside. So let's say you buy a stock for $10 and it goes to zero, your potential downside is $10. Well, when you're shorting a stock, the potential downside is infinite, because let's say you buy a stock for $10 and it goes up to $100 in value. Well, now you've lost $90 per share on that stock. And this is what happened in the case of these short sellers who were short selling GameStop. Because what had happened is they had sold stocks for $5, $10, $15, and then the price started to go up. And as the price started to go up, they had to cover their losses. So let me give you another example on this just to make it really simple. So let's say you're in a position where you are selling a share short at $1, and the value of the stock goes up to $10. Now you have to buy it back at $10, so you've lost $9. Now let's say it continues to go up to $100. Well, now you've lost $99. And all of a sudden, the trade where you thought you were only investing $1 ends up being a trade where you are losing almost 100. And then multiply this by a significant number of shares. And that's what happened here. So using GameStop as an example, people had short sold the stock for $10. And then they got to the point where they potentially had to buy it back for $300 or $350. So let's just use that as an example. They short sold it at $10 and had to buy it back at $300. So they lost $290 per share. Now let's say they had made a $10,000 short sale at $10. Well, now when they have to go back and buy back the stocks to cover their losses, the $10,000 bet they thought they had made ended up being a $290,000 loss. And that's on an initial trade of just $10,000. So this is what was happening to the hedge funds that had sold short the stocks. And as a result of them having to cover their losses and buy back shares to cover their losses, it compounded the effect, increasing the price of the stock, and it just kept going up and up and up and up, till at one point it was at $450, which is insane. So what had happened in technical terms is a group of Redditors on Wallstreetbets, about 2 million of them as of a week ago. As of right now, there's almost 3 to 4 million of them. They had basically put the short squeeze on institutional investors. So it's a David and Goliath story where a whole bunch of Davids got together to beat the heck out of Goliath. And as a result, they made a significant amount of money. In fact, one trader is said to have earned almost $47 million. Now, I don't know if he locked in the profits or not, but he made a pretty significant amount of money just by buying the stock and going with the wisdom of the crowd and basically putting the screws to the man in this case. So that leads us to part number 2 of this story, which is investing on the wisdom of crowds, which is at the best of times not the best idea. Because basically what people tend to do is they tend to ride the mania. This is what happened during the dot-com bubble, where everybody invested in tech stocks, and then the majority of people lost a ton of money because they got in too late. And this is what happened in the housing market in 2007, when everybody bought houses because housing prices could only go up, and then they were proven wrong, right, Michael Burry? And then on top of that, this is what's happening right now with GameStop and with AMC, because as of today, as of when I'm filming this, the values of both of those stocks have absolutely plummeted. Because what happened was on Tuesday night, the media came out and said there's a meteoric rise in GameStop and AMC, and a whole bunch of people flooded into the market on Wednesday morning. Now, if you got into the market on Wednesday morning and you got out on Wednesday afternoon, you probably did pretty well. But if you held into Thursday morning, you got your butt kicked. And that's because inevitably any sort of investing trends that go through the roof for no reason other than just mania, well, they always tend to come crashing down, and that's what happened on Thursday. So let me tell you the third part of this story. Because the third part of this story, even though I don't suggest investing on the wisdom of crowds, is that every once in a while, about 2 to 3 times a year, there becomes this opportunity to make an investment in these sorts of trades and these sorts of investments that have no reason to go up but are. So here's how I played these stocks. On Tuesday afternoon, it became very clear that these stocks were going to make a huge run because they were getting a ton of media attention. So what I did is on Wednesday morning, I went in and I bought shares of both AMC and GME. And I bought them with the expectation that I needed to limit my downside. And the way you limit your downside, or the way I limited my downside, is I put a stop loss on them. So in other words, if the value of the stock went more than 20% below what I paid for them, then my brokerage would automatically sell them. And the reason I do that is to mitigate my potential losses. And you have to remember as well, anytime you're making this sort of investment, you have to be 100% willing to lose the money that you're investing. Because the reality here was I wasn't investing, I was speculating. To me, this is the same as going to Las Vegas and putting my money on the blackjack or the craps table. And here's what my plan was. My plan was to limit the downside if I lost 20% of the value that I put into these. And again, it was a very small portion of my portfolio value that I put into these. Well, then I would just eat the losses and move on. But I figured there was the potential for me to run up in a single day a pretty significant amount of returns. And that's exactly what happened. By the end of the day on Wednesday, I was able to earn on AMC a 29% return and on GameStop a 12.5% return. Now, I am by no means a day trader because being a day trader inherently is a risky strategy and it makes you put money at risk on a daily basis in order to earn returns. But every once in a while, there's this sort of scenario where there's some mania in the markets where you can basically take advantage of what's bound to be a run-up. And then the key is to get out of the market as fast as possible with a small return compared to what other people are making, but a return nonetheless. So I was quite happy if I made 10% on a day on both of these stocks. Obviously, I did far better on AMC and I did a little bit better on GME. But the key thing for me was making sure I got out on Wednesday night, because what I was concerned about was what the SEC might do on Wednesday night, or what these different investing platforms might do on Wednesday night. And sure enough, the SEC did nothing, but on Wednesday morning, different investment platforms like Robinhood stopped allowing people to buy these stocks, and therefore the stock came plummeting down. And it shows that I was able to get out at the right time, because what I was trying to do was mitigate my risk. And to me, holding it through the night was pretty risky because you didn't know what different companies, what different organizations, and what different regulators were going to do while the market was closed. Now, the other thing I watched during the day on Wednesday was the volumes. And what was clear was that on Wednesday morning, there was pretty significant volumes, but that the trend was on a downward trend. And what that told me was that the shorts were in a position where they were either done covering their short positions, or they just no longer wanted to play the game. So when the volume started to go down pretty significantly, that's when I started to make my move to get out of the stocks. And ultimately what I ended up doing was making a 29% return on AMC. I bought it at about $14.75 and sold it at $19. And on Gamestop, and I'll put the images here, showing exactly what I bought and sold them for. But on GameStop, I think I purchased around 305 and sold at around 345. Now, I'm blurring out the amount that I invested and the dollar value that I invested at, because I don't want what I invested and the gamble that I made to be something that is indicative of what I think other people should do. Because again, you need to make, when you're making this sort of gamble, and that's what it was a gamble. It wasn't an investment, it was a gamble. I gambled on the fact that I could ride a little bit of momentum for a day and make a little bit of cash, and that's what I did. And each individual needs to do that on their own. They definitely shouldn't be looking at what I invest or what other people invest and try to, follow the crowd and do what other people are doing. That's what's gotten a lot of people on Wallstreetbets in trouble this week, is they tried to follow the wisdom of the crowd, and a lot of people emptied out their life savings, invested in GameStop at $350 or $400, and have lost a pretty significant amount of those investments. And the moral of the story is this: regardless of what you're doing, if you don't understand what you're investing in, you shouldn't be investing in it. The easiest thing, if you want to be an investor and you don't want to dig deep into how to invest in different strategies and so on and so forth, is go and read like a Tony Robbins book like Money Master the Game or Unbreakable or Unshakable, whatever the name of that book is, and try to mimic a portfolio using ETFs and just keep it safe, keep it simple. And if investing and gambling and speculating is something that you want to do with a very small portion of your portfolio, and what I'm talking about is maybe 1 or 2% of your portfolio, then fine. But definitely don't be the person that goes out and follows the dude on YouTube or follows the Redditors on Wallstreetbets and gambles their entire life savings. So that's it. That's my thoughts on this whole situation. It was a once-in-a-lifetime opportunity for a small group of investors to basically make a pretty significant amount of money by sticking it to the man and sticking it to a bunch of short sellers. I applaud them for doing it. I don't necessarily applaud different organizations who stopped allowing people to buy and make their own investment decisions and therefore artificially deflated the already artificially inflated stocks, but that's what you need to be wary of when you make decisions like this, is there are things that are outside of your control that you can't manage and ultimately can end up costing you a ton of money. So interesting story, interesting set of circumstances. Don't be a gambler, don't be a speculator unless you're 100% willing to lose the money. And if you found this video useful, do me that favor, hit that subscribe button. You don't need to speculate to hit the subscribe button because you will get the value out of that. And do me that favor, hit the like button, and don't forget about our race to 10,000 subscribers. Again, hit that subscribe button for me. I know it's worth it. I know you know it's worth it. And we'll see you on the next video. Cheers.